Joining me now is Barry Knapp. He is managing partner and director of research at Ironsides Macroeconomics. Barry, it's great to see you again. I mean, do you have the concern that we could see kind of a 2023 recession event because they're so far behind the curve, or does not even that bother you?
I'm not particularly concerned. As much as Chairman Powell may admire Paul Volcker, there was a long, drawn-out political process to get anywhere near the will to do what Volcker did in the, starting in 1979 and on. But I just think we have to step back and realize what the setting was. Now, I agree that the rate of change of policy tightening is a factor, and you can certainly shock the markets and economic activity. But I've been arguing that policy was actually counterproductive at its current setting. House prices going up 1.5% per month, 20% per year is a much bigger problem than a 4 versus a 5% mortgage market for real millennials forming households. We clearly had lots of malinvestment, money flowing into all sorts of speculative investments. All that cash sitting on bank balance sheets is impairing profitability, and that itself could crowd out credit creation much more than so-called maturity transformation, the inversion of the curve, is likely to do so. And of course, inflation expectations are a problem in the near term as well. Larry Summers has described those longer term expectations, which are much lower relative to the near term expectations, as a wasting asset. So it's important the Fed gets going. But I think we have to understand in the early stages of them normalizing policy, they're taking away counterproductive, overly accommodative policy. They're not coming anywhere close to tightening.
Absolutely. And what I like about your perspective is, you have the macro, but you also translate it to markets. So why does that leave you bullish on U.S. equities when you see kind of the inflation picture that's out there? Why are you more bearish on real estate? Maybe you just say, these gains aren't sustainable, but walk us through where you think investors should be positioned right now.
Sure. A lot of this does have to do with, and real estate's a bond surrogate, right? But so a lot of this has to do with the yield curve and causation here. I've been arguing for quite a long time that real rates and nominal treasury curves have not been a good proxy for growth, going all the way back to the conundrum back in 2004 and 2006. It's a little bit of a long story, but if you look at what's happened so far this year, the real driver of the nominal curve inversion has been a deep, deep inversion of the break-even curve. In other words, the market expects inflation to fall very sharply in 2023 and beyond. That deepening of the inversion curve, correlation doesn't prove causation, but if you run the regression against that versus the nominal curve and the real rate curve versus the nominal curve, you see that the driver is this expectations that we're at or close to peak inflation. So if you think about it in that context, and you say, well, gee, equities rallied after the Fed took some steps towards regaining credibility after the March meeting. And yes, the curve flattened, rates went up, but credit spreads tightened. This is what you'd expect in an environment where the market's telling you, yeah, inflation's probably going to peak and get better. Now, I have a quibble with where it's going to wind up in 2023,
right,
but that's a story for another day. In the meantime, it's good news for equities. It's good news for the reflationary sectors, and clearly bad news for the bond market, although it appears at this point that the mortgage market and mortgage extension has probably burned itself out, and the Treasury market will probably trade in a range. I don't think it'll reverse the moves like it did in the second quarter of last year, but it'll probably get stuck in a range here.
Shepard Smith here. Thanks for watching CNBC on YouTube.